Hi, Catalina here. For those that do not know me, I am the CEO and founder of LoanSense. We reduce student loan payments, adjust, and improve debt to income and help people close on a house, among other financial goals. But today's video, this is for lenders and loan officers. I've been seeing a lot of, and of course, anybody that also wants to buy a home, been seeing a lot of news on how student loan forgiveness is going to impact mortgage performance. And there's a lot of information out that is saying the impact on mortgage performance is low. And they're looking at it. This recent article from the National Mortgage News Network that was released on the 16th of September was evaluating the number of people that go into mortgage delinquency and talks about how the forgiveness is not going to significantly affect the customer base and their portfolio that goes into delinquency, because only about 16% of their portfolio of those going into delinquency have student loan debt. And I wanted to make a point in this video to mention that this is a very narrow perspective on how to look at the impact of the loan forgiveness programs, along with Biden's overall announcements. It's not just forgiving 10 to 20,000 of loan forgiveness, but it's also making an adjustment to the way people will pay back their undergrad student loans. For every single undergrad graduating, they will lessen, the administration and the Department of Ed will lessen the payback obligation by less than half. And the reason I say less than half is because not only is it changing the percent of the payment, discretionary income payment, from 10% of your discretionary income to 5%, but it's also lifting the amount that they will subtract from, like, the requirement to live. Essentially, it's called discretionary income, but the requirement to live will go from 150% of poverty line to 225%, which means if they lift the amount it costs to live in the formula, which it should because of inflation, clearly it costs more to live now than it did 10 years ago. If they lift it from 150% to 225, then the amount of money left over to pay back your student loan decreases, plus the percentage you have to pay back also decreases. So it's going to less than half your payment for undergraduate loans. The impact of that is huge, is because if, let's say, your payment after you graduate would be $400, let's just say around $400, with the average amount of borrowing being over $40,000 now for an undergrad degree. And let's say instead of paying back that $400, your income suggests that you can only pay back, and based on this new 5% rule, you're only going to pay back $100 instead of $400. That literally frees up $300 just from undergrad education to now be able to do things like buy a home. This is really, really important, because let's say they go back and get a whole bunch of grad school debt. The undergrad debt will still be subject to the 5% repayment. The grad school debt will be subject to a 10% repayment. Of course, that may increase their income, but their obligation to pay back is still lessened, right, based on this formula. So this Biden repayment plan, this new repayment plan that's going to be established, is going to be how the mortgage industry is going to be impacted by Biden's new ruling and student loan forgiveness programs. It's not about the actual $10,000 of direct relief, and it's not even about the $20,000 of direct relief. It's about how he is restructuring the repayment. Also, by not making the student loan forgiveness a federal tax line item that consumers and borrowers have to pay back, that enables people to not just get relief, but they are not going to be taxed on that relief, which means they will not owe more money to the IRS at the end of the year, which means that they can use their savings towards down payment instead of towards paying taxes on student loan relief. Granted, there are states that will require borrowers to pay tax on the relief. The full list of states it's not been released. Like, not every state has released their policies yet, but as you can imagine, more conservative states, for the most part, will require a tax on the forgiveness, and more progressive states, minus California's thinking about possibly taxing forgiveness, will not be taxing the forgiveness. And federal taxation on all loan forgiveness has been suspended until 2025. And that is actually laying down the groundwork for permanent tax forgiveness on any relief into the future. That's not been declaratively decided yet, but the groundwork for the current policy suggests that that will be so. So just again to reiterate, how does this affect the mortgage lending industry? It does not affect it based on the 10K of forgiveness. It affects it based on the new restructuring of the repayment program. However, another aspect that lenders and loan officers are not accounting for is the fact that a person's ability to buy a house is as much psychological as it is actual and real. And the reason I say this is because you can calculate DTI and have all these requirements for qualification, which is really, really important to have someone in financial standing to be able to purchase without putting them at risk of delinquency or going into foreclosure on their home. But a person's desire and feeling ready to buy is a very much psychological feeling. And so if you come out of this pandemic pause, of student loan pause, and you are now, your student loan payment to pay back has now, let's say, been cut in half or has been eliminated, you are now much more psychologically ready to use that payment amount plus some, depending on your employment status, to save for a down payment or to say, hey, I'm now ready to buy a house because my student loan obligation has been lessened, right? And so much of buying a home is psychological that I don't think has been accounted for in these numbers as well. And of course, it's a great opportunity for lenders to speak to borrowers who are unsure about how to get forgiveness, how to file the forms, what to do. We can partner with you to help borrowers get that relief so they can feel psychologically prepared to buy. Even if they're not ready today, you are building up your pipeline for future borrowers because why fight over the 1% that it's going to buy over the next week and not prepare the people that are going to buy over the next 3 to 6 months so that you build your pipeline along the way, right? So that's what we recommend. I hope this information has been helpful, has added to the food for thought for the week. If you like this content, please do not forget to like, to subscribe, and to share with other loan officers who you think, and lenders, as well as people, those in the position to purchase or thinking about purchasing a home with student debt. Please share this information. I hope this has been helpful. Please, any questions, do not hesitate to leave them in the comments. I try to answer all the questions. Again, our site is myloansense.com. If you're interested in learning more as a loan officer and as a lender, how to partner with us, please visit our website, myloansense.com, and we cannot wait to demo our technology and to answer your questions. Have a great rest of the day.